What's up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and Wall Street just woke up from its AI-fueled sugar rush and realized, oh crap, the economy is still a mess. Last week, the markets got panicked, and the S&P down 2.4%. The NASDAQ down 2.2%. Big tech caught an uppercut. And the Dow, oh sweet boomer Dow, down over 500 points thanks to Trump's new favorite hobby, global trade Jenga. Why? Simple. Because every piece of soft landing fantasy just fell apart like Elon Musk's PR team after a tweet. Let's go ahead, stop with the foreplay, and just dive straight into this. So, segment one, we got the job market dumpster fire. You know things are bad when the president fires the head of Bureau labor statistics on Jobs Day. Yes, really, Trump fired BLS Commissioner Erica McIntyre on Friday. His exact words, she faked the numbers, which honestly sounds more like a breakup text than a macro policy response. But hey, maybe he was just mad because the July report came in ice cold. Just 73,000 jobs added versus 104,000 expected. Unemployment ticked up to 4.2% from previous 4.1%. 258,000 jobs revised away from May to June, and labor force participation is dropping again. That's not soft landing energy, that's brace for impact energy. Now, why does this matter to you and your portfolio? Well, the market went from everything is fine to we need a rate cut yesterday in about 4 hours. September cut odds 83% and rising on a daily basis according to the CME Fed Watch tool. Now, Fed credibility somewhere between WeWork IPO pitch and relying on Reddit for trading advice. Now, the next thing we have up is our Fed Watch. Will Powell fold faster than cheap lawn furniture from Walmart, or is he going to take his time? He's in the middle of the ring, and one glove says inflation is still sticky. The other, labor's breaking. Trump's yelling, cut now. Markets are yelling, cut or we riot. And Powell's standing there like, can someone pass me a Negroni? Fed fund rates still at 4.25% to 4.5%. The 10-year yield above 4.25% now, signaling markets think Powell's about to fold faster than a meme stock trader in a bear market. Now, why does this matter to you? If the Fed pivots too fast, it's a signal things are really broken. If they wait too long, credit cracks, labor fails off a cliff, and, well, I'm going to go ahead and buy some puts. Powell's trapped, and the market absolutely knows it right now. Now, the next thing is AI still prints hype, but it's not printing returns right now in this market. So let's talk about the market's favorite new toy, artificial intelligence. Yes, it's still red hot, and yes, companies are still spending like they just discovered venture capital. Meta is up 12% after earnings. Zuckerbucks to the moon. Amazon is down 8%. AWS disappointed, and Jeff Bezos didn't even take his shirt off to distract us. NVO is down 20% because slashing guidance is apparently the new flex. The big picture with all this, earnings reactions have gone full psycho. Miss both revenue and EPS, you drop nearly 5% on average, worse than the last 5-year norm. Now, why does this matter to your portfolio? Investors are saying, don't show me potential, show me results. No more passes for vibes and promises. It's delivered or get dumped. Now, our final thing here is our earnings roulette because, well, we have 122 S&P 500 names reporting this week, and a few are high stakes AF. PLTR, government contracts, plus AI dreams. Can Palantir monetize memes? Eli Lilly, everyone's GLP-1 daddy. Will Ozempic keep paying the rent for them? Disney, can Mickey Mouse stop bleeding cash in streaming? We have semiconductor AI server play. No pressure, just don't miss, and please stay in line with the rest of that whole division because it already took a dump last week. And then Uber, profit, or just more tech-enabled taxi cab nonsense. Now, earnings this week, why should you care? Well, this is a make or break season. Investors are exhausted. If earnings don't impress and forward guidance doesn't impress, support breaks faster than Lucid's battery supply chain. Now, what is our weekly outlook and calendar for the week? Well, that's simple. Monday, we have factory orders. Expect a plunge, down 5%. it's not ideal. Tuesday, we have ISM Services PMI. That's the service sector, which equals the last domino standing in this. If it drops, well, things are going to get uglier than two cousins kissing in Alabama. Wednesday, we have mortgage apps. Cue the violin music because, well, if you know anything about the housing market right now, the last thing people are doing is investing in real estate unless you're a hedge fund. Thursday, we have jobless claims. Last time it jumped, Powell blinked. So go ahead and watch that. And then Friday, we have no major data, just vibes, exits, and whales using you as exit liquidity. So let's go ahead, make like a condom, and wrap this whole thing up. This market is built on hope, hype, and humming servers in Azure data centers. But here's the thing. The jobs report killed the soft landing narrative. The Fed's stuck between cut and, oh God, we have to cut, which, by the way, last time we did, oh God, we have to cut, 75% of the Federal Reserve came out a month later and said they regretted giving those cuts. Yes, that's that 50-point basis cut we got last year. That, well, quite frankly, put us in a worse economic situation than we were a year ago. Tech can't save us alone. Not with earnings and misses and guidance drops. Honestly, at this point, it's just the Achilles heel of the market because it is the thing that's holding up this market as well. And tariffs, well, they're back like it's 2018 and with extra spice. So what's the move here? Stay nimble, be selective, and don't chase. Watch earnings, track options flow, and for the love of Powell, hedge your risk. Drop your top trade in the comments, share this with a trader who still thinks buy the dip is a personality trait, and subscribe unless you like learning about macro after your portfolio's down 12% and you have to go and move it back to your mom's basement. Stay sharp out there. The everything rally is over. Now it's just risk everything.